rents are obviously increasing with inflation. So a lot of savvy investors are buying real estate because it's a great inflation hedge, right? So what the investors are setting up right now that are purchasing these types of loans, they're doing what I call a make sense loan this time. They're not doing the zero down stuff with the that's going to adjust in 2 years and no source of no income verification, all that stuff.
So welcome to another edition of Tuesday Tips with Brent and Lee. If this is the first time you've been to our channel, here we talk about real estate, money, and mortgages. And today we're talking about real estate, money, and mortgages with our good friend, Brent Starts from Unitas Lending. How you doing today, Brent?
Doing great, Lee. How are you?
I'm doing great. So before we get started, if this is the first time you've been to the site, please don't forget to slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. Put up new videos every single week. So today we're going to talk with Brent about investment property. We've gotten comments and calls from different clients. Is this still a good time to buy investment real estate? So we really want to break that down because some new information has come out on the market and what's happening with different experts and what they feel like the market's going to be doing the real estate market's going to be doing over the next couple of years here. So we want to cover that and give you some insight on where to look to purchase rental property and investment property where you're going to get the best bang for your buck, and where not to, based on what experts are predicting 2023 and 2024 are going to look like. So let's go ahead and get started with Brent and talk a little bit about what we're looking at in the future for investment property. So Brent, first talk about right now, there's a lot of new programs out there for investors. So let's talk first about those programs. Share a little bit about the different types of programs and loans that investors can use to buy rental property.
Yeah, they're getting really creative because there's so much demand now. Rents are obviously increasing with inflation. So a lot of savvy investors are buying real estate because it's a great inflation hedge, right? So what the investors are setting up right now that are purchasing these types of loans, they're doing what I call a make sense loan this time. They're not doing the zero down stuff with the that's going to adjust in 2 years and no source of no income verification, all that stuff. These are make sense loans. So they're about 20% down for investment property, 1 to 4 units. Now this would be for 1 to 4 units, 20% down to a 620 FICO score. And then there's some nuances, but basically you can go conventional, which would work, and you'd probably be in the mid to high fives right now. So the rate would still be very low historically. And then the more creative programs, bank statement loans using bank statements as income. In other words, no tax returns. So if you own a business, that type of thing, and the cash flow is strong through the business, using those tax returns those bank statements as opposed to tax returns. And then of course we have the DSCR, the debt service coverage ratio loan. So basically, in a nutshell, what that is, if the rents, the market rents of the property would cover the principal, interest, taxes, and insurance, that's considered the income qualified. In other words, the property is the income, that's potential to earn income. And so that way the investor's never in trouble. They know that it's a positive cash flow situation. You have to have decent credit to do this, but it's a great way to have that hedge against inflation in the coming years.
Right. All right. So there's a lot of different programs, obviously. So one of the things that I do think that investors need to be savvy about right now is where they're buying property. So there's some new research that came out this month talking about where experts believe the market will end up as far as home price performance goes and equity. So they're looking at, 2022 somewhere nationwide being 9%, and then 2023 equity dropping to around 4.7%, and then 2024, we're getting back to around 3.5%. So, but that is nationwide. So different markets will have a different, growth as far as equity goes. So one of the markets that we've been in and we work in is Port St. Lucie. And Port St. Lucie, for the last 8 years, as you've known, we've watched it move at 10 to 15% a year. And then COVID, it just went absolutely nuts. I mean, people are getting, making $100,000 a year in their homes, in anything they're buying right now. We basically, if you bought a home 6 months ago, investment property, you're covering your mortgage plus, you made $50,000 already in it. So Port St. Lucie is a great market. And when you look at historically the market, that 10% a year, you're still okay buying a home as an investment property with rates where somewhere around 5.5 to 6%. Do you not agree?
I agree, absolutely. And you have to remember historically what happens in times like these. We're not in this isn't our first rodeo, right, Lee?
Right.
I mean, we've seen this before. We've seen this movie. And so what we're seeing is, interest rates going up, and basically the Fed has been telegraphing that basically, hey, they're going to have 8 hikes this year of a quarter or a half point. 1 or 2 of them could be a half point. So it's really baked into mortgage rates. They really wanted to keep, frankly, they wanted to keep the 10-year Treasury below 2.5, and we're already there. So I think, will they be able to raise it that much? I don't know, because I think the market's already responded to those messages the Fed has been, kind of throwing out there through speeches and things. So I think, I think, the market is basically simply supply and demand. So to answer your question with rental property specifically, there's just too few houses, so rents are going to keep going up and prices are going to keep going up because it still makes sense. We've talked about the how much room does it have to run, right? When we've had a year like we've had this past year. And like I say, I lived in California for 23 years, and I never thought it could grow to the degree it did. But people get really creative because they understand real estate is a great long-term hedge against inflation, and basically it's a retirement program for most people. It's where most of their wealth is held, is in real estate, historically and traditionally. So I think it has a way to run, and I think healthy, dropping to 5% appreciation would actually be a healthy market. I'd like to see it because it can't run, above income. The income has to match, right? Or the rental income that it can generate. So even if personal income doesn't go up, if rental income or rents increase to cover that payment, it can run even further. And so with the shortage of housing, I see it being really solid long term.
Right. And the thing so let's talk the difference for folks thinking about, South Florida, is it a good place to purchase rental property? Before COVID, Palm Beach County was growing somewhere between 3.5 to 5%. And then COVID hit, and then everything went crazy, right? But if we're talking about over the next, couple of years here, the market returning to more of a normal market, we're for sure looking at Palm Beach County returning to that 3.5, 5%. Because in Jupiter and Palm Beach Gardens, you're looking at an average sale right now somewhere between 800,000 to 1.4 million on any given month. So, that this market has way less to grow than, say, a Port St. Lucie, where the average sale is somewhere in the 400s. So you can still buy a nice rental property from, around $450,000 that's, under 5 years old, which would keep your insurance down. And, it'd be something that people would want to move into and you'd have very little repairs with. So with that being said, that's where everyone's moving to. They're coming from South Florida to Port St. Lucie, where Palm Beach County, we just really don't have a lot of places to build new construction. So everything being built here is starting in the millions, where you have new construction in Port St. Lucie starting in the, you know, the 400s. So I think you have a lot more run. And as an investor, I want to be able to make as much equity if I can't cash flow as I can. And you're really not going to cash flow anywhere in the United States right now with real estate, because you're not really able to pick up foreclosures, because the foreclosures snapped up before it ever goes into foreclosure, or you know, the bank gets it back, it's gone.
I agree 100%, 100%. And there's some creative things we can help with that cash flow, Lee. I think we talked about, you know, the 40-year loan. And it's with a 10-year fixed option. So there's a way to, you know, or 10-year interest only, rather. It's fixed for 40 years. You know, it's an interest rate that's fixed for 40 years with interest only for the first 10. So that, you know, it drastically decreases the payment, which improves your cash flow immediately. So you have 10 years of raising your rents 3 to 5%, whatever inflation is per year. And it may be more than that per year because of the, you know, inflationary, you know, environment we're in. So you've got 10 years of solid cash flow, and knowing that, you know, by that point in time, when it flips to the fully amortized, you have another 30 years to pay it down. So that's a great strategy to get into the property, into an investment. And it's a fixed rate, you know, so it doesn't adjust. Sometimes people say, well, isn't that what got us in trouble in 2008? The problem there was no equity. Now there's equity. And in these programs, there's 20% built in equity, and it's cash flowing from day one. Very few people walk away from a property that has, you know, they're in it for 20% down, plus they're making money every month, you know, $500 to $700 a month, you know, so it's a very different scenario.
Well, if anyone has any questions for Brent or myself, we're here to help you any way we can. Both our information is in the information section below, so feel free to reach out to us. Leave a comment in the comment section. We'll answer those questions as always. And again, if this is the first time you have been to our site or you haven't subscribed, go ahead and slap that subscribe button right there. Ring that notification bell so you don't miss any of our real estate tips and tours. And be kind to each other, and we'll see you next time.